Hi, good day. So our topic for today is cost accounting. This focuses on cost concept, meaning the definition and the explanation of each cost. So what is a cost accounting? Cost accounting usually is a quantitative method that accumulates, classifies, summarizes, and interpret information into three major functions. And these are the operating, so that we would know the cost per se of the operations, and then for special decisions, that's why we have some relevant costing, and for the product decisions. Okay? So our learning objective is to learn the different cost concept and to learn the different kinds of cost and its use. So what is cost concept? Cost concept is used to analyze the cost of our short-term and long-term project. So normally the short-term project is like the working capital, the inventory. So these are expenses that would usually incur or outright expenses. That's why in our inventory there is also the so-called semi-expendable items that are normally 10,000, 15,000 and varies depending on the entity. Whereas the long-term project, these are also what we call now as our capital expenditure that are sometimes financed by the borrowing costs. So for our financial statement, we have the borrowing costs. And these are also our long-term projects like building, cars, or our fixed asset that would incur costs but could be used for more than a period of time. And usually, the building or the paying of the loans that are related to this project would take a longer period than 1 year. Next, we also state that all acquisitions should be recorded at cost. Remember, when we say recorded at cost, it is usually the acquisition cost. That's why in our partnership accounting, remember that when there is an admission of the partnership, we usually revalue the different asset so that it would be recorded at fair market value, which is the current cost of all the assets and equipment at that moment. That's why we revalue, because revaluation is usually as if we acquire or we started a new entity. Okay? Next, we have different classification of costs. The natural classification, or usually this pertain to our product cost. So we have three. Number one is the direct material. Those material that are easily identified, conveniently measured, and directly charged to the cost productions. So example of these are when you are into manufacturing a table. So when you manufacture a table, these are the wood, the nails, the paint, and anything that you could directly identify as materials of this particular product. Like for example, if you are engaged in a food business, these are normally the direct material that are used to produce the food, like the flour, if it's cake, or those that you know directly being used by that particular entity. So these are directly charged to the productions. Next, we also have the direct labor. The direct labor are those people who are actually touching or directly touching that product. So these are referred to the employee or temporary staff who directly on the manufacturers of the product or who directly manufactures the product. Like for example, the wood, the carpenter, the painter, if you are into a furniture business. Okay? And then another thing, we also have the factory overhead. So factory overhead are other costs incurred in manufacturing activities that are not directly attributable to the manufacturing. Example of these are the supervisor, the quality control, the lighting, the utilities expense that are directly associated but you cannot directly identify to the product. That's why there are other called for the direct material and direct labor are also called as the prime cost. Why prime? This because these are the two costs that are primary or necessarily needed in order for the product to become finished or become saleable to the market. Whereas direct labor and factory overhead are also called conversion costs. Why? Because direct labor and factory overhead are the one that convert the material into its finished product. Remember, you cannot tell the wood that, hey, wood, become a chair. It cannot be done. You need a labor and then the machine in order to crave, to cut, to paint this wood. That's why the direct labor and factory overhead are also called conversion costs. And the direct material and direct labor are also called primary or prime cost. Okay? Next, we also have the indirect labor and indirect material. So, indirect labor and indirect material are sometimes also called as our factory overhead. Why? Because these are material costs that cannot be allocated or cannot be apportioned or absorbed by the cost center or the cost unit. Example, if you need nails or the glue, it was so small in amount that you cannot even identify it to the product. Or for example, you are into a chair or furniture business, but you cannot, if you buy a glue so that it would be used for that product, you cannot directly identify what amount of each particular product has used. Use the amount of glue. And then you also have the indirect labor. These are the supervisor, because supervisor usually supervise all the staff on different productions. So this refers to the employee who does not engage directly in the conversion of output but contribute indirectly. So these two are also known as our factory overhead. Next, according to production, so we have fixed cost. Fixed cost is used which does not vary in total for a given time and fluctuation in production or volume of activities. Other term are capacity or period cost. This is also so-called the volume. Remember, in break-even, we would determine what number of product in order for us to get the fixed cost. So normally, the fixed cost is the one that you incur despite not producing anything. Like for example, the depreciation. These are fixed costs because you are already bought this particular equipment, but since you're not using it, it become idle, and when you're using a straight line, it still depreciate despite no production. Okay? Like in our utilities expense, for example, we have our electric bill. Sometimes it still have a cost despite we're not using it. Or our water bills, despite we are not around in that particular place for quite some times, there are still the maintenance costs. So these are what we call now the fixed costs. Next, we have variable costs. So variable cost is the cost that change directly according to production. Meaning, for every single product that you produce, you incur additional costs for that. For example, if you are into producing cupcakes, so each cupcakes, when you produce one cupcake, you put additional flour. When you make two cupcakes, you produce additional flour. So these are variable costs, or those are that are directly to that product. The sugar, so it would depend on the number of cupcakes you do. But the oven, if it's not full in capacity, so there is the fixed cost because the oven would depreciate, and the amount of light that are needed to bake that cupcake or the number of hours would still be the same despite of the number of cupcake, unless it already has its volume or satisfy the entire volume. That's why in our cost concept or in our standard variation, we also have the so-called volume variance. We also have the idle capacity. Next, we also have the semi-variable and fixed. So semi-variable and fixed, these are the costs which remain fixed at a certain level of production, but after that, it become variable. Or some would also use the step cost, because at each level, this amount, and then on the next level, it's a different amount. Like for example, our electricity. So if we incur a higher wattage of electric, our costs or the variable cost increases depending on the number of usage. So take note, fixed cost in volume is the same but increases per watt if only one product is produced. So it's inversely proportional with our variable because variable is directly proportional with the number of production. Okay? Unless otherwise, there is a saturation of the capacity. Next, we also have the degree of relationship. So we have the product cost. So product cost, these are costs that are identified to the product and merged in inventory. value. So, for example, the product costs are those that are related to our inventories. So, meaning, these are not outright expense on this period of time. So, usually, the product costs involve our direct material, our direct labor, and factory overhead. We also have the period cost. These are costs which are not identified with the product activity during the period in which they are evolved. So, normally, period costs are what we incurred during the period whether we produce or we did not produce. That's why in some cases, if we are already in our managerial accounting, we would know the absorption cost and the standard costing, on which under the standard costing, we usually eliminate the fixed cost unless it was tagged as our product cost. Because sometimes fixed cost is also period cost, because despite of producing or not producing, you still got to incur depreciation expense. Okay? So it depends upon the period or when you expense it outright. Like for example, water bills. So if you are into baking, that could be product cost because you would put water into it. But sometimes, even if it's not using the water because there are fixed charges, it become period cost because despite there's no production, you still incur the cost. Next, we also have according to function. So, manufacturing costs could also synonymous to our product cost because these are the cost of material plus the cost to convert the material into finished product. So, this involve the manufacturing cost usually involve our direct material, direct labor, and factory overhead. Whereas administrative costs, these are costs represent the necessary cost to maintain the company's daily operation and administer its business, but these costs are not directly attributable to the production of goods and services. So normally, these are our accounting. Now, they are not directly attributable to the product, but they are essential to the entity to determine whether the entity are functioning or not, or to determine the different production or the so-called the support department, our HR. So these are the administrative costs. While selling and distribution costs are expenses which are incurred to promote sales and service to customer. So anything about selling and distribution, like our promotion, our freight out, these are what we call now distribution because we are bringing now the product to our clients. That's why it was also called selling or distribution. Anything that pertain to the advertising or for us to sell that particular product will now go to our selling and distribution costs. Like for example, freight in is a manufacturing cost because you cannot produce the product without bringing it to the warehouse. That's why it's manufacturing cost. Whereas freight out is distribution because you are now bringing the product to your customers. Okay? So, according to decision, we have opportunity cost. So, opportunity costs represent the benefit an individual investor or business misses out when choosing one alternative over the other. So, example, assume that a manufacturer can sell semi-finished product to a customer for 5 million. He decided, however, to keep it and eliminate it. The opportunity cost of the finished product would now be 5 million because the amount of economic revenues rejected the manufacturer of the product. Simultaneously, the capital will be invested to other planned inventories cannot now invest to share the same earnings. So, in our layman's term, for example, when we wanted a bag and a shoes, and we buy a bag instead of the shoes, then the opportunity cost would now be the cost of the shoes because we bought the other one, which is our bag. So meaning this is the cost that we choose, that we eliminate because we choose the other alternatives. Okay, like for example, now in pandemic, what is our opportunity cost? So opportunity cost is our transportation in going to the office because we cannot go to the office. Instead, we have an additional cost which is our internet and our electricity since we are connecting on our respective electricity in our homes. Okay? Next, we also have the relevant costs. So relevant costs are related to future and differ in different alternatives. So usually a relevant cost is are costs that basically in the future or to be incurred in the future. Example, a business firm purchased a plant for 2 million and has now a book value of 200,000. So the plants become obsolete and can be sold for only 50,000 with some modification. So the modifications and the cost to sell is the relevant cost. Why? Because you could either incur it or not to incur it. For example, in our current situation, so the relevant cost is the cost that if we go out to our home and do other things, so we could also incur expenses, and we could either also contract the virus in going out. So this could now be relevant information for us, and the cost for some medications would be relevant for our decision not to go out. Okay. Next, we also have the so-called imputed costs. So imputed costs are costs that are not actually incurred in some transaction, but which is relevant to the decision as pertain to a particular situation. So normally, imputed costs are costs that are to be paid or charged because this is involved or relevant in our decision making. For example, nowadays, since it's COVID, we could either still open our business and not to open our business. So there are imputed costs with that one. Imputed costs are the one when we were be able to caught as a violation. So there could be fines and penalties. This could also be purchase of raw material and the outlay that would enter within the system and the interest we would earn in doing this particular or inventory. Okay, and another thing, for currently, the other imputed cost would be the rental expenses because some of our lessor does not become good enough not to ask to pay for our respective rentals. Okay. And next, we also have the so-called sunk costs. Sunk costs refer to all past costs since the amount cannot be changed or incur. So these are costs that we had already bought or something that we cannot anymore undo because we already paid the price for that one. So for example, if our lessor wasn't that good enough, that still impose some rental charges, this even though we are not in operation, that could also be sunk costs because we still had to pay or we already paid in advance and the lessor did not grant us any modification not to pay for that one. That could be sunk costs. Next, we also have differential cost. These are the increase or decrease in the total cost between two alternatives. So there are different. So nowadays we have what are the different costs. So most people now venture to online businesses, and some previously they are into their respective store. So the differential cost now would be the rental expenses and the internet cost and the advertising cost used to sell more products. Okay. Next, we also have the out-of-pocket cost. This refers to cash outlay due to a particular management decision. So out-of-pocket costs nowadays are these are costs that we already need to incur because you choose this particular alternative. Like for example, the internet cost, we had to pay it outright, or especially if you are a prepaid. And then the shutdown costs are costs that are to be incurred despite the business stop operation. So this one is also the cost why most of the entity close their businesses, because shutdown costs are fixed costs or other costs that cannot be eliminated despite no operation. Like for example, the rental, the salary of some of the employees, the amortization. So these are still costs that are to be paid despite no operation. And this is also the reason why most of the entity shut down their businesses or declare bankruptcy, so that they would already avoid the shutdown costs. Lastly, we also have the different control. We have controllable costs, or costs that can be influenced or regulated by the head of or the responsible for it. So a good example of controllable costs are salary, because they could terminate the service of the entity of a person. The production, they could stop the production. So these are controllable by a certain person. Next, we also have uncontrollable costs, or costs that cannot be under the control of specified management. So for example, the depreciations, because you had to incur it. The rental, if you cannot terminate it because there would be some breach over the contractual agreement. And next, we also have other costs. We have the joint costs. These are expenditures that benefit more than one product and for which it is impossible to separate in the contribution to cost production. So normally, a joint cost is a product that are associated to 3 different products. For example, if you are into a business of meat shop, so the joint cost is the cost of the entire pig. Okay? So these are the joint costs, because even though you have a separate price or a different price for each part of the pig, the joint cost was the slaughtering and the pig itself. Next, we also have the common costs. These are costs that are attributable to a specific cost, such as the product or the production cost. So for example, the common cost, if you are using this pig to produce different product, you have the meat shop, you also have the cold cuts, you are into. So the joint cost would be the pig, because you had to separate each cost, and then the common cost would be down the slaughtering and the advertising, so that you will be able to sell the particular product. And next, we also have the committed cost. These are costs or expenses that the management consider permanent and cannot be eliminated, tend to cost the company higher over time. Example, there are contracts that you cannot terminate. So since there are already contract, it is committed cost, because any termination would mean breach of contract or would loss of the opportunity to transact business with this organization. Next, we also have the discretionary costs. These are costs associated with the business activities that are not directly tied to operational procedure and therefore cannot be reduced or removed without halting the business in a short run. So discretionary costs are depending on the discretionary, or meaning on the discretion of the upper person or the higher level of the entity. So meaning we could remove or reduce this cost despite the, for example, in pandemic, most employees are laid off, or instead of paying salaries, they were now being paying by their leave credits. So these are discretionary costs. And so that's all. We're gonna use this particular different kinds of costs in our process costing and manufacturing costs and job order costing for our future cost accounting lecture in our channel. So guys, thank you for watching. If you like this video, please help me reach out more people by hitting the subscribe and the like button below. God bless you and keep safe. If you have questions, please comment below so that I could get back to you and answer. Thank you and good day. God bless you all.